Up. A short word that's a tall order. Up your game. Up the ante. And if you stumble, you get back up. Up isn't easy, and we ought to know. We're in the business of up. Every day, Delta flies 250,000 people while investing billions improving everything from booking to baggage claim. We're raising the bar on flying, and tomorrow, we will up it yet again.
Although the decline in the number of willing and qualified potential homebuyers explains some of the contraction in mortgage lending in the past few years, I believe that tight credit remains an important factor as well. The Federal Reserve's Senior Loan Officer Opinion Survey on bank lending practices indicates that lenders began tightening mortgage credit standards in 2007 and have not significantly eased their standards since then. Terms and standards have tightened most for borrowers with lower credit scores and less money available for a down payment. For example, in April, nearly 60% of lenders reported that they would be much less likely, relative to 2006, to originate a conforming home purchase mortgage to a borrower with a 10% down payment and a credit score of 620, the traditional marker for those with weaker credit histories. As a result, the share of home purchase borrowers with credit scores below 620 has fallen from about 17% of borrowers at the end of 2006 to about 5% more recently. Lenders also appear to have pulled back from offering borrowers loans that are insured by the Federal Housing Administration, the FHA. When lenders were asked why they have originated fewer mortgages, they cited a variety of concerns, starting with worries about the economy, the outlook for house prices, and their existing real estate loan exposures. They also mentioned increases in servicing costs and the risks of being required by the government-sponsored enterprises, the GSEs, of repurchasing delinquent loans, the so-called putback risk. Other concerns include the reduced availability of private mortgage insurance for conventional loans and some program-specific issues for FHA loans, as well as reasons for tighter standards. Also, some evidence suggests that mortgage originations for new purchases may be constrained because of processing capacity, as high levels of refinancing could have drawn on the same personnel who would otherwise be available for handling loans for purchase. Importantly, however, restrictive mortgage lending conditions do not seem to be linked to any insufficiency of bank capital or to a general unwillingness to lend. Certainly, some tightening of credit standards was an appropriate response to the lax lending conditions that prevailed in the years leading up to the peak in house prices. Mortgage loans that were poorly underwritten or inappropriate from the borrower's circumstances ultimately had devastating consequences for many families and their communities, as well as for the financial institutions themselves and for the broader economy. However, it seems likely at this point that the pendulum has swung too far the other way, and that overly tight lending standards may now be preventing credit-worthy borrowers from buying homes, thereby slowing the revival in housing and impeding the economic recovery. The factors contributing to reduced mortgage lending and lower rates of home ownership are varied and complex. No simple solution exists that can, on its own, restore the housing market to health. Since the extent of the crisis became apparent, though, a range of initiatives has been undertaken. For example, a number of public and private efforts have been made to avoid unnecessary foreclosures and to enable underwater and other borrowers to refinance at lower rates. Alternatives to foreclosure, including short sales and deed in lieu arrangements, have become more common. The recent settlement with a large group of servicers includes provisions to improve the process for working with delinquent borrowers and to compensate foreclosed-upon homeowners who were unfairly treated in the past. As I've noted, vacant foreclosed homes lose value and create problems for neighborhoods. The overhang of empty homes also slows the recovery of the housing market by keeping prices low and limiting the need for new construction. To explore ways to address the number of foreclosed homes standing empty, the Federal Housing Finance Agency, which supervises the GSEs, undertook a pilot initiative that made it easier for qualified investors to purchase pools of foreclosed properties from Fannie Mac. and the acquired properties would then be rented for a specified number of years. For our part, the Federal Reserve is encouraging the institutions we supervise to manage their inventories of foreclosed homes in ways that do not exacerbate problems in local neighborhoods, including renting them out when appropriate, rather than leaving the properties vacant. Policymakers have also taken steps to remove barriers to the flow of mortgage credit. The Federal Housing Finance Agency recently announced new rules that will provide mortgage lenders greater clarity about the conditions under which they will be required to buy back defaulted mortgages from Fannie Mae and Freddie Mac, or otherwise address origination problems. This greater clarity may result in reduced concern about putback risk, which in turn should increase the willingness of lenders to make new loans. In its rulemakings and supervision, the Federal Reserve, along with other bank supervisors, has worked with lenders to try to achieve an appropriate balance between reasonable prudence and ensuring that qualified borrowers are not denied access to credit. Although regulatory policy will be important for restoring a fully functioning housing and mortgage market, the strength of the overall economic recovery is crucial as well. Obviously, loss of employment or income makes it more difficult for families to pay their mortgages, to maintain good credit histories, to refinance their mortgages at lower rates, and to avoid foreclosure. People who are worried about their jobs are understandably more reluctant to purchase homes, and households who have suffered hits to their income face difficulty qualifying for a mortgage and saving for a down payment. Concerns about the financial strength of households and about the economic recovery also make lenders more cautious. At the Federal Reserve, we have sought to support the economic recovery and maintain price stability, the two goals given to us by Congress, by keeping both short-term and longer-term interest rates historically low. Low interest rates reduce the cost to households of buying homes, cars, and other consumer durables while increasing the attractiveness of new capital investments by firms. Increased demand, in turn, leads to faster economic growth and more jobs. My colleagues and I have been quite concerned about the stubbornly high level of unemployment, particularly long-term unemployment, and we have taken strong actions throughout the financial crisis and the recovery to help stabilize the economy. In September, we took the added step of stating that we will continue actions to put downward pressure on longer-term interest rates until the outlook for the job market improves substantially in a context of price stability. Our hope is that our statement provides individuals, families, businesses, and financial markets greater confidence about the Federal Reserve's commitment to promoting a sustainable recovery with price stability, and that, as a result, they will become more willing to invest, to hire, and to spend. In addition, of course, the historically low mortgage rates that have resulted from the Federal Reserve's policies are directly supporting the housing market by putting homeownership within the reach of more people.